The crypto party ended in a flash. One moment the streets were buzzing with excitement, and the next, silence settled in like a heavy fog. Bitcoin had just hit a record high, and euphoria was everywhere. Investors toasted their wins, convinced the good times would never end. Then, on October 10, 2025, the market didn't just dip, it imploded. Prices tumbled so fast, even seasoned traders were left breathless. In just 24 hours, 19 billion in leveraged bets vanished into thin air. Phones buzzed with alerts, and disbelief turned to panic. That's 9 times bigger than any previous crash, and 19 times the FTX collapse. The scale was almost unimaginable, sending shockwaves through the entire industry. Over 1.6 million traders were wiped out in a digital massacre. Bitcoin plunged 15%, Ethereum 21%, erasing months of gains in a single day, and altcoins like Dogecoin and Avalanche lost over 60%. Projects that once promised the future now looked like relics of a forgotten era. The entire financial ecosystem felt the shock. From Wall Street to small-town investors, no one was spared from the fallout. The crash was a brutal reminder. Crypto is still wildly volatile and unpredictable. Hopes and dreams can evaporate in an instant. October 2025 became the textbook case of how fast fortunes can turn, and how quickly the music can stop. The party lights faded, leaving only uncertainty behind. The hangover was just beginning. For many, the lessons of that night would echo for years to come. What triggered the collapse? The answer wasn't a shadowy cyber attack or a technical flaw. It was something far more unpredictable, an eruption of global politics that no algorithm could foresee. Not a hack, but geopolitics. The world's most powerful nations suddenly found themselves at odds, and the ripple effects were immediate. President Trump announced a sweeping 100% tariff on all Chinese imports, sending shockwaves through the global economy. He didn't stop there. He threatened to block key software exports, escalating tensions to a fever pitch. Global markets panicked, unsure of what would come next. Investors dumped risky assets, especially crypto. The sell-off was relentless, as fear gripped traders from New York to Hong Kong. The dream of crypto as a safe, independent system evaporated instantly. Overnight, confidence in digital currencies vanished, replaced by anxiety and doubt. Money rushed to gold and U.S. Treasury bonds, the classic safe havens. Investors sought shelter in assets with a proven track record, abandoning the new for the old. The exodus was swift and brutal, exposing crypto's vulnerability to real-world shocks. The market's optimism was replaced by a harsh, new reality. Institutions that had cautiously entered crypto retreated to what they trusted. Years of slow progress were undone in a matter of days. The crash proved crypto wasn't the hedge or uncorrelated asset its fans claimed. When the world shook, crypto was shaken hardest of all. Instead, it was the first thing to go when trouble hit. The promise of digital independence crumbled under the weight of global uncertainty. The US-China trade war didn't just make headlines, it popped the year's biggest bubble. The consequences were felt far beyond Wall Street or Beijing. The fallout was global and immediate. From bustling cities to quiet towns, the shockwaves of this geopolitical gut punch were impossible to ignore. Fear took over. Panic selling spread like wildfire. FOMO flipped to terror. Everyone wanted out, fast. Billions in wealth vanished in hours, devastating life savings and retirement funds. But not all money left crypto. Many dumped altcoins and fled to Bitcoin, hoping it would hold. Bitcoin became the digital safe haven as altcoins burned. This showed a maturing market. Investors now saw a hierarchy, with Bitcoin at the top. The crisis revealed both the fragility and the evolving logic of digital asset investing. The fear was real, but so was the shift in strategy. The trade war was the spark, but leverage was the fuel. As tensions escalated between global powers, uncertainty rippled through the markets, making investors nervous. But beneath the surface, a much bigger problem was brewing, one that would soon turn anxiety into outright panic. Traders had borrowed massively, betting big in the bull run. Fueled by easy credit and the promise of quick profits, they piled into risky positions, convinced the good times would last forever. Margin accounts ballooned, as everyone chased higher returns. When prices fell, exchanges triggered automatic liquidations, selling off assets to cover debts. Suddenly, traders who thought they were in control found themselves powerless, as their positions were wiped out in seconds. This set off a brutal chain reaction. Falling prices caused more liquidations, which caused even more selling. Each forced sale pushed the market lower, creating a feedback loop that no one could stop. The $19 billion in liquidations didn't just result from the crash, it drove it. The sheer scale of forced selling overwhelmed buyers, turning a correction into a full-blown rout. The market's structure, overloaded with borrowed money, turned a dip into a disaster. What could have been a manageable setback became a financial landslide, exposing just how vulnerable the system really was. It was a textbook long squeeze, exposing the dangers of excessive leverage. Traders who once felt invincible were left with nothing but losses and regret. The lesson: leverage can turn a shock into a catastrophe. Even a small spark can ignite a financial inferno when borrowed money is everywhere. The system was fragile, and one spark brought it all down. In the aftermath, the true cost of risk became painfully clear to everyone involved. Risk management wasn't just a suggestion, it was survival. In a world built on borrowed money, only those who respect risk can weather the storm. As panic selling surged, the crypto infrastructure buckled. Liquidity dried up. Everyone wanted to sell. No one wanted to buy. Prices crashed even faster, and major trading platforms glitched or went offline. Investors were locked out, helpless as their portfolios evaporated. Even stable coins wobbled. A major one briefly lost its dollar peg, shaking confidence further. If the stable part of crypto wasn't safe, what was? The technical breakdowns didn't cause the crash, but they made it far worse. The market became a digital horror show: fear, chaos, and no way out. Trust in the system was shattered. The crash exposed just how fragile the digital financial world could be. When the dust settled, the lessons were clear. Leverage is a double-edged sword, amplifying gains but also risk and loss. Crypto isn't immune to global events, it's deeply connected to the world's politics and markets. The myth of Bitcoin as a safe haven was shattered by a single trade war announcement. Risk builds quietly in good times, then explodes. Warnings about leverage and institutional sell-offs had gone unheeded. This wasn't a black swan, it was a disaster waiting to happen. Diversification, skepticism, and understanding risk are more important than ever. Technology changes, but human psychology, greed and fear, remains the same. The scars from October 2025 will remind everyone. In crypto, euphoria and disaster are always just a headline apart.